Hi everyone, it's Ashley Rhodes here. Welcome back to my channel. If you are planning to buy, sell, or invest in a condominium anywhere in Utah, the rules of the game just fundamentally shifted. Starting on August 3rd, Fannie Mae and Freddie Mac officially retired the limited review process for established condo developments. For years, if you put 10, 20, or 30% down on a condo, lenders barely even looked at the HOAs. They checked your credit, verified your income, made sure the building wasn't on fire, and approved your loan. These days are completely over. Now almost every single condo deal is forced into a full review. Lenders are digging into HOA budgets, reserve studies, meeting minutes, and insurance policies. If the HOA doesn't pass inspection, your loan gets denied no matter how great your credit score is. In this video, I'm breaking down the 4 major changes rolling out across the end of 2026 and early 2027, how they directly impact Park City and Salt Lake City real estate, and what buyers and sellers need to do today to avoid a collapsed deal. Let's break down the mechanics of what Fannie and Freddie are actually enforcing. Number 1, mandatory full reviews. Without limited review, lenders must now examine the condo association's full financial package. They want to see balance sheets, pending litigation, deferred maintenance, and years of board meeting minutes. Number 2, the reserve requirement jump. Historically, an HOA had to allocate at least 10% of its annual budget directly into a reserve fund. Starting January 4th of 27, that jumps to 15%. Even worse, for disorganized HOAs, Fannie Mae is banning baseline or near zero reserve funding models. If an HOA relies on a reserve study, it must fund the study's highest recommended level. Number 3, the $50,000 insurance deductible gap. Master insurance policies on condo towers have gotten insanely expensive, so HOAs increased their master deductibles. Fannie Mae now caps acceptable master deductibles at $50,000 per unit. If the master policy deductible is high, the buyer is now required to carry an individual HO-6 interior insurance policy specifically endorsement coded to cover that master deductible gap. Number 4, the 2 to 10 unit exception. It's not all bad news. Small boutique condo developments with 2 to 10 units are getting an expanded waiver of project review. So if you're looking at a small townhome style setup or boutique infill property, you actually face less red tape with these new regulations. Now, why does this hit Utah so uniquely? Because our condo ecosystem in northern Utah is heavily split between high-density urban developments and luxury resort properties. Let's start with Park City and resort condos. In Park City, many condo developments operate with complex rental pools, lock-off units, or resort amenities. HOA boards and ski communities often deferred maintenance or kept reserves low to avoid pushing dues up on second homeowners. Under these new guidelines, if a Park City HOA hasn't kept up with reserve studies or has structural updates pending on balconies or underground parking, they instantly become non-warrantable. Now, when a building becomes non-warrantable, buyers cannot use traditional 15 or 30-year conventional fixed mortgages. They are forced into cash-only or non-QM portfolio loans with higher interest rates and 20 to 30% down payments. Now let's look at Salt Lake City high-rises and infill. In Salt Lake City, we have seen a massive wave of condo construction over the last decade. Older buildings in areas like the avenues or downtown that haven't yet raised HOA dues in years are facing a massive reality check. If their annual budget doesn't hit that 15% reserve line by January, every owner in that building could see their property values impacted because future buyers won't be able to get standard financing. So let's look at strategies for buyers and sellers. If you are actively navigating this market, here's your playbook. If you are buying, first, don't just look at those granite countertops. Before you fall in love with the kitchen, your agent needs to request the HOA questionnaire and current budget during your due diligence period. Second, check the reserve line. Look closely at the HOA budget. Is it at least 10% and ideally 15% of assessment income going into reserves? If it's borderline, get ready for a potential special assessment or dues hike down the road. Third, review the board minutes. Ask for the last 12 months of HOA board meeting minutes. Look for words like special assessment, roof repair, elevator maintenance, or litigation. And if you're a seller, same thing, get ahead of the paperwork. HOA management companies are getting slammed with these 10-page lender questionnaires, and they can take 2 to 3 weeks to fill out. Be proactive and order your HO documents and reserve study before you put your condo on the MLS. Second, vet your buyer's lender. Make sure the buyer's loan officer actually knows how to process a full condo review. A newer lender who doesn't realize limited reviews are gone will promise a 21-day close and then blow up the timeline at day 18. The takeaway here isn't to be afraid of buying or selling a condo in Utah. It's simply that the easy button shortcuts are gone, and working with an agent who understands how to audit HOA health before you go under contract is non-negotiable. If you are thinking about listing your condo or you're shopping for one in Salt Lake City, Park City, or along the Wasatch Front, reach out to me directly. I can help you pull the HOA documents, review the warrantability status, and make sure your transaction moves smoothly without sudden surprises. Drop a comment below if your HOA has already raised dues this year. I'd love to hear what you're seeing in your building. Don't forget to like, subscribe for more weekly